I want to start from my analysis, which I did 2 days ago or a few days ago. If you can see at the top of the screen here, it says 2 days ago. And in this analysis, we pointed out that actually, unfortunately, I cannot zoom the screen, but we pointed out that we would have a reversal at this point simply because we hit this zone here, which if you looked at the zone from a regular candle, you would see that this was a previous support level, and which of course I would expect, highly expect that to be our current support level as well, since it's also corresponding, it was corresponding to that level over there. So we did make a U-turn right around here, a reversal, and I just want to play that real quick. And we see that if you took this trade from here, you bought a call which was 3 days out, you would have made that money out there. Okay. With that all aside, let's go back to what we want to take a look at, or what I want to show you today. And what I want to talk about is going to be continuous analysis of SPY. Okay. Here, right here with me, I want to show you what really you would do in situations where, depending on in situations where the price is not going in your favor. And if you ever watch my videos, I normally talk about how you can trade or start your day or set up your trade with the opening range breakout and high Kanashi candles. Okay, I will be doing this analysis primarily using high Kanashi candles, and because of that, I will at one point maybe set up, I mean, change the whole entire chart to the traditional candlesticks. Okay, and a few things here. Before I get started, I want to explain a few. I want to talk about a few things that I have on my chart. First of all, I have my all candles in Aikanashi, which I already mentioned, and then I have this whole cloud here, which is red and green over there. That is just a moving average, which is painted a little bit differently. Right below, between that cloud and that vertical, I mean horizontal blue line, that blue line is my opening range breakout, which is targeting the opening and the closing of the first candle when the day opened. In between those two is a skinny blue line. This blue line is our moving average. Okay, so we have those two. We have the moving average, we have the opening range breakout, and then we have the VWAP. Okay, the VWAP and opening range breakout kind of just does the same thing, but a little bit different. Okay, the VWAP will stick with you for a little longer, but the opening range breakout will always stay the same. Okay, with that in mind, I want to change my time frame. I normally trade intraday. I normally trade with the 7 minute chart, but let's use this 15-minute chart. But before I actually do that, let me mention something. If you are trading with high Kanashi candles, okay, try to identify what I call the spinning stops. Okay, the spinning stops are candles that looks like this. They are all together. They're trying to find a direction to follow. These candles here. Try to find those spinning stops, identify those spinning stops. They can be before or after the market opens. These spinning stops here, these are kind of telling you that the trend has been exhausted a little bit where they are. Okay, those spinning stops. And if there are too many candles with wicks before the market opens, do not take the trade on the direction that the opening range breakout opens to. If it's not below, it's not confirmed by if it is not confirmed by the VWAP itself, and everything is not below the moving average. Okay, do not. If it's not clearly seen, do not take the trade. That is just my simple advice. A good example. Let's see here. The momentum was good. Momentum was good, meaning that whichever side it breaks to will have momentum still. Okay, momentum was good here on this day, and the opening range we had that doji candle over there. The doji was followed by a strong candle, which is great, and that was above everything, above the VWAP, above the hard moving average, above the opening range breakout. That's perfect. Okay, that's what we want. Let me reset the chart. Again, let me put my candles to 15-minute chart. Okay, and with 15-minute chart, I actually have a feeling that I should change, not change, but I should change from extended hours to regular hours so that we're looking at data that matters. Looking at the data that matter, we do see that yesterday was a beautiful day. How do we spot yesterday again? Yesterday is these candles which are labeled or painted black. Any candle which is painted black is where your previous day is. So the way I normally trade, if you have watched a lot of my videos, I do normally paint a lot of spots. I paint the previous day low and I paint the previous day high. Okay. In this case, yesterday, the previous day low was here, the previous day high was there. Today, you might have noticed, or if you haven't noticed, today we did open, this was the previous day low, and we did open right on the previous day low. I mean, previous day high, sorry. This was the previous day high, we did open right at the previous day high. That previous day high took a little bit of time to break, to break through on the other, on to the other side. And just by, if you have this up, just by looking at the struggle that the candles are having or the market is having within that zone, you wanted a clear breakout of this previous day. Okay, and you can see how every consolidation was inside the previous day, even though we had our opening range breakout already broken at one point. We were still not closed outside the opening range breakout with a clear candle. So this where everything broke, that was a perfect breakout. Okay, with that in mind, the line that I already drawn here prior to this video, which is, let me adjust it a little bit over there. Actually, I will not make it a line. Let me delete that so that we can have a zone. Zone is better because it's not specific. It gives you a range. Okay, so let's have that as a zone. So meaning tomorrow we are expecting that if price opens above that, which of course this is a very skinny zone or a very tight zone, and beside that tight zone I mentioned just a few seconds ago, try to identify spinning stops. We do have quite a bit of spinning stops here, and we do have quite a bit of dodges here, meaning that, and also we're looking at a 15-minute chart, meaning that whatever happens in the morning, we should have a strong breakout to either to the downside or to the upside. But let me show you something here. Stick around. Something that you haven't noticed is that we are actually quite very close to the all-time high. And just to draw that, I will draw that all-time high, which let me see here which one is higher. Okay, the all-time high is, well, let's use this candle right here. This is the tallest wick above everything else, I would assume. Not just assume, but that's what I can tell. We draw that line, we pull that to the right, and we make that a zone. Actually, not quite. Let's take it that way. And then let's take it the other way around. Right over there, okay? If we adjust or zoom out on this right here, it really wouldn't matter at all because this is still within the zone. What matters is the movement towards this line. If we just want to know if the price is going to be drawn towards that line, but we know for sure if it goes up this far, it should be stopped right here. So meaning, if price does open tomorrow to the uptrend, we want to be able to take profit right away within that zone. And let me paint that red just so we know it's our resistance level. This is a major resistance level that you're looking at. So that major resistance level has to be respected. With that in mind, the way we moved today, we moved a little bit more than the distance left for tomorrow. So meaning, let me just make a quick prediction here. If I take a look at this on a daily chart, okay, if I take a look at this on a daily chart, we are trading with Ikenashi. You know very well, or if you haven't noticed, Ikenashi the next day opened in the middle of the previous candle. Meaning, today's candle, the average is already drawn for us, this dot right here. Okay, that dot right there. So meaning, if we go ahead and put a line on that dot around 52 something there, that means that's where our day is going to open tomorrow. We expect price to open around 552, and because it's going to open around 552, we are expecting to hit that daily high tomorrow, which is 559, previous day high. So we're expecting to open around here, and we should have a spike to the upside, and that spike might hit that support level. I mean that resistance level real quick, and there's no doubt about that, because if you look carefully on my chart here, we have this is a bullish momentum on a high Kanashi. I don't know what it looks like on a regular candle. We will get back to that in a second, actually. But more importantly, if you look at my momentum here, okay, moving average here, it has a a bullish momentum, meaning that we are just starting to have a little joy for a bull ride, okay. And that bull ride, it doesn't matter how long or where it's gonna end, but I know for sure it I would be scared that it ends around that red zone over there. That's a resistance level. So keep that in mind, that we are just getting bullish here for a moment, and that bullishness will continue a little bit, because this has just begun, and this cannot just be stopped right away. So we'll have this effect taking, we'll have this trend taking effect shortly, which the day should close. If it doesn't close on that red, it should close enough to that red. And if we take a look at the regular candle or traditional candle, you will see that the level that I've marked here, it's not technically the previous day high, but the benefit of using Heikin-Ashi is that it grabs the average of certain events and gives you that average, not the actual data that is displayed on the regular or traditional candle. And of course, if I put this back in a 15-minute chart, you're probably not gonna like it, because it's quite very noisy. On a regular 15-minute chart, you will see that it would have been very difficult to spot this orange, which, let me paint it green, zone here. It would have been very difficult to spot this green zone here. It looks like so many green things. Okay, let's make another choice here. Okay, let's do that. All right, aqua. Maybe that's, I don't know if that's aqua, but let's call it aqua. So that aqua color there, it would have been very difficult to spot that on a regular time frame. Okay, and because of that, you would have missed. A lot of people would have misinterpreted this as, if you're trading opening range breakout on a traditional candle, somebody would have seen that the day opened on red, next candle was red below below everything. But remember, we were still above this green. So that would have been a little bit of a red flag. But if the next was to close below that, that would have been perfect one. But it got rejected on this high moving average. So it's easy to see all this thing in a high Kanashi candle. With high Kanashi, it's pretty straightforward. And again, take a look at the high Kanashi. With high Kanashi, we have spotted that level right away, which is the previous day high. We just take the wick from the body to the wick itself, end of the wick. Okay. Um, yeah, and we stay within that zone. We buy right when we break out of the opening range breakout, after we have seen a doji candle, and then we exit when we see the next doji candle. That is your entry. I mean, your exit, and that is your strategy. Just keep it simple. Meaning, if you haven't watched my other video, what I said last time to a lot of people was that you identify your entry spot. In this case, it's this doji. You get in the trade after you've seen a huge candle without a wick on one end. That's just a clear momentum forming up. You stay in that trade for as long as you are building stairs, either to the upside or to the downside. You exit that trade when you see a doji form up. In this case, let's use these two little guys. Okay. As soon as you see a doji form up, you exit that trade. I don't know what this looks like on a regular candle, but regular candles doesn't tell you entries and exit a lot of the times. Well, it does. They do tell you a lot actually, but they do not really get interpreted really easily by beginners traders. So on a regular candle, you would be looking for this bullish engulfing candle, because I call it the bullish engulfing candle because the body of this um, but the body of this green candle entirely takes off, swallows the red candle over there, which is before it. And we did see that doji actually still representing itself, but dojis are normally interpreted differently and in many ways. Of course, it's a clear reversal, but it can also mean a slight pullback. So that's all interpreted differently. That's what I mean by it's interpreted differently. It can mean a slight pullback or it can mean an actual reversal. But on a regular candle, you cannot tell exactly. However, on a high Kanashi, when you see that, you know for sure it's a reversal, not just a pullback. And a best or a great example, not today, but yesterday. Yesterday was beautiful, beautiful, beautiful. Okay, the day opened strong. We have that doji. Next candle was perfect, no wick at all. Everything was already below. Look at this. If you look at this, everything is below the whole moving average already. We have already tapped that VWAP. We are already below the opening range breakout. Get in the trade. We get in the trade. We buy our put option, or you sell your call right there. You buy your put or you sell your call right there. You stay in that trade for as long as you are building your stairs to the downside. Okay, you're building your stairs to the downside. As soon as you see, the wick on a doji, the wick, a candle with a wick on both sides, you exit that trade right there, and then a new journey begins. That same candle is your entry and exit. You enter on the next one. If it forms up with a strong momentum is identified by a candle with no wick. We clearly saw that right here. Everything broke above the moving average and the VWAP. Like I mentioned earlier at the beginning of this video, that VWAP sticks with you for a little longer, but the opening range breakout stays in the same spot for, of course, as you can see, for the entire trading period. I do know for sure there's one thing. If you haven't noticed, I will make it clear. I have actually, maybe I will make that in a different video. There's one thing you can do every day and you will not miss a thing. If you miss the first trading session, there's another session that comes up. If you look at the candles carefully, you will see that there's a specific time frame, there's a specific spot where everything is exactly, the pattern or the behavior is exactly the same. I will let you find that by yourself. If you haven't, send me a message. I will show you what it is. So yeah, with that in mind, that is how you trade those. And like I said, there are days that you enter the market with a little bit of a wick. Do not enter the trade if their wicks are still there. This, like for example, if we had a first candle green, some people would be like, okay, we're green, we're gonna go up. Next candle forms up, it's a wick, which is red, but then that red got picked up by a momentum. No wick on the other end. Perfect. Okay, just like beautifully perfect. This was a struggle, but this struggle was not that bad. Okay, if you spotted and you were keen enough, you could have exited, taken this tiny ride, or waited for the second session. If normally when the opening range breakout is this, the distance is this wide between the opening and the closing of the first candle. If that distance is that wide, I normally don't take the trade. I wait for the second period. My second period starts not so far from where this red candle ends, and I've already actually revealed that. So I've made it easy for you for your assignment. And again, that second period is right about where this green candle ends. Not so far. Not green candle, right about where this red candle ends. Not so far. And the same thing repeats itself. And you look here, again, like I said, the day opens, you see a candle with a wick, followed by another candle with a wick. Do not take a trade. Another candle with a wick, one without a wick, take a trade. And just be quick, get out. Okay? Identify your entry. This was beautiful. Day opens, nothing up going on. Okay? So anyhow, just check around, do your research, stick with opening range breakout if you're new to it. just read around and check me back regularly. Okay, I will make this available for you for free.